My name's Aaron Weaver. I'm a principal or a portfolio manager at Apeiron Investments. We're a private investment group founded by Christian Ungermeyer, who is a early investor into the longevity space. But we principally do a lot across life sciences, fundamentally areas of socioeconomic need that have a lack of development efforts. So we did a lot within the mental health care space, helping advance psychedelic therapies and a variety of other fresh perspectives or approaches to alleviating the mental health burden there. We saw a similar opportunity to get to invest early into the longevity space, sort of seeing the appeal and the need, plus the prospective returns for innovators as a result of being early entrants in the longevity space and just understanding the transformative potential that longevity will bring about over the next number of years and decades. Unfortunately, I'm speaking without slides today, so hopefully this will be just relatively simple and you can follow along. But my aim here is really to talk about investment methodologies and frameworks, just to give you a couple sound bites that you can think through when you're effectively evaluating investment opportunities within the space. What I'll focus on is probably really the idiosyncratic factors pertinent to assessing an investment in a longevity company. And that will fundamentally focus on biopharmaceutical business models, because for people that are new to investing in this space, new to investing into biopharma, it is different in a way to investing into consumer-facing businesses. And I think if you're able to appreciate those differences, it will go a long way. So, I think thanks to Phil before we actually heard the case for longevity, I think it's undeniable that we're actually entering into a new decade or era of huge transformative potential. Being an investment or a market participant within this space, I think will actually help your ability to assess a broader range of companies that will advance, I'd say, the technological agenda over the next decade. What I genuinely feel is that we're about to embark upon a sort of biotechnological and bioengineering revolution. Peter Thiel had, a number of years ago, had quipped that we wanted flying cars, and what we ended up with was 140 characters. I think that was him expressing his dismay at what he thought would be an era of technological transformation. Instead, we basically got a series of social media platforms and businesses that did seek to connect the world, but it wasn't really the 0 to 1 moment that he was effectively aspiring for. I believe that this now is the 0 to 1 moment that we're aspiring to. We're looking at fundamental technologies that will actually change the face of humanity, and getting a grasp around an area such as longevity will actually bear, I'd say, fruit for foundational knowledge that will help you assess areas of synthetic biology, also organic substitution into information technology systems such as prospective methods of DNA printing that would be used for information storage, etc. But I think what's really important here is that this is probably one of the biggest secular trends that we're going to see over the next couple of decades, and I think it's probably on par with the discussion that's occurring around technology that can help appease the climate change challenges that we're effectively facing. So I think Phil just spoke before about there being a classification of 25 domains within the longevity industry. I'm probably going to pull that back to about 2 business models fundamentally. One of which I mentioned before, which is sort of consuming-facing businesses, which I will just cover over very, very quickly. But then I'll actually deep dive a little bit more into how to assess a longevity company that operates as a biopharmaceutical company. Fundamental difference between the two here is that one type of business, the consumer-based business, doesn't need a regulatory approval in order for its products to be marketed and made available to consumers. Whereas for biopharmaceutical companies, they undertake a regulated process where they'll have an investigation of a new drug that will be taken through a clinical trial process. I'll touch a little bit upon what a clinical trial process looks like and fundamentally what the research of that looks like, helping advance what prospectively is a drug candidate through clinical trials. So consumer-based businesses is, these are products that purport to have longevity benefits. They don't have a regulatory approval attached to them, so they need to be very mindful of the types of marketing claims that they sort of effectively market out to the public. When you look at these companies, I'd probably say use a very conventional investment type of framework, which is effectively assessing the TAM, product market fit, looking at managerial capabilities, and also looking at matters of financial performance, because ultimately at the end, we're talking about huge promise and appeal within the industry, but as we've seen in the sort of market readjustment that's occurred within the last 12 months, profitability is key. Your ability to have a sustainable and recurring revenue base is also really, really critical. And I think one point of emphasis to really outline here is because I think that we get really amazed by the degree of technological and scientific progress that occurs within the space, and I think it's very easy to get tied up in assessing the merits of that and what it prospectively holds out for changing fundamental aspects of our biology, and particularly sort of slowing down the aging process. Please do think through whether the general public will be able to discern those arguments around the scientific merits of what the product is trying to effectively advocate. Because one thing I will say through my own investment activities is that I think consumer purchasing behavior is probably more driven by emotional factors than rational factors. So the question really is how does that message get across to the general consuming public? The other type of business model I really want to speak about, and this is where I'm going to sort of focus most of my attention today, is the biopharmaceutical business models, which are just fundamentally engaged in research and development. They take investigational drugs, those that purport to alleviate some type of disease burden, and in the differentiating circumstance here for longevity drugs, probably the dual purpose benefit of being able to extend human health span and lifespan. These types of businesses don't generate revenue, but what they do have is as they progress their research and development through the various stages of clinical development, you will see an accretion in value ascribed to them. And that's generally through further up rounds of investment from venture capitalists and other types of market participants, and then also prospective investment off ramps, whether that's IPOs, M&A activity, licensing deals, and a variety of other ways that market participants can transact, which actually is a clear demonstrable mark of the value that's being created through those R&D efforts. The one point probably then about valuing these companies, if you can't actually, if you don't have a valuation metrical guide such as revenue or EBITDA to look at them, generally you're fundamentally looking at peer group analysis. So please get familiar with the sort of the general competitive landscape in which these companies are effectively operating. And most investors will effectively put together our discounted cash flow models that will have a degree of risk adjustment for the clinical probabilities of success. And that can give you an idea about what the intrinsic value of the company would prospectively look like. Doesn't necessarily mean that the market will ascribe that value, but being able to understand at least those operating numbers and those prospective revenue forecasts with some degree of intimacy is, I would say, a good undertaking and a good exercise for really understanding what the prospective revenue generating appeal of these entities are. I think the next point I really want to touch upon was sort of return expectations and how you ought to think about the revenue potential of these companies and what meaningful economic impact they could effectively make, and actually really characterizing this by how are they going to sell, what's that revenue profile effectively going to look like. And one thing I'll say to everyone in this room, I do think that you're very fortunate assessing the longevity space at this moment in time. We are going through quite a bit of macroeconomic and geopolitical turmoil. That turmoil, it really means that we have generation low entry points for investment into big secular areas and themes, which during your investment period will probably mean that the market cycle will be in a significant uptick by the time that your exits come out. So the investment adage of buy low, sell high, structurally, you're actually sitting within this type of investment opportunity at the moment. You can fundamentally think of it as having an opportunity to get on the ground floor, like the early days of the modern internet, where Amazon, Google, and PayPal were effectively getting started. And if you have a look at what the founders of those companies are actually doing now with their money, they're actually putting it into this space in significant quantums. So first aspect of appeal in terms of just return profiles is that you're probably going to see an outsized return expectations that sit within the space, because these companies do pay out insignificant multiples when they're effectively transacted via M&A or IPO or further accretion within the markets when they actually reach particular types of clinical data readouts. One thing that hasn't been baked into that, and there is a lot more upside potential in longevity companies, is the prospective downstream revenue appeal of them acting as gerotherapeutics, where they're either taken up for off-label use, or there is a change within the regulatory environment which would actually permit the drugs to be taken on a prophylactic basis and actually intervening or alleviating disease even before it effectively becomes symptomatic. One of the other sort of, I'd say, salient factors around looking at investing into sort of longevity drug development companies is that it fundamentally is an uncorrelated asset class. Anyone that's probably looked through, certainly I know I have, but looked through their the performance of the personal investment portfolios this year will probably see every asset class is red at the moment. And I wouldn't say underperforming, but it's, there certainly is a loss of value across most fundamentally every asset class. Questionably, this could extend into next year. People don't really know how long. I think there's a number of broader issues that effectively need to be resolved. But there is a broader immunity to interest rate environments and matters of inflation. Geopolitical turmoil, I think, won't really significantly affect this industry. Foreign exchange fluctuations won't become an issue whatsoever. And then if you look at the longevity industry on a comparative basis to other high growth technology sectors where you could prospectively allocate your money, there's a real fundamental appeal here, because I do think that some of the others, for example, crypto has market integrity issues where there'll be a forthcoming regulatory overhaul. I think financial technology and some of the business enterprise focused software areas are subject to that significant retreat within enterprise spending and inflation-based readjustments. And then general consumer categories are going to have to handle the sort of global recessionary headwinds. The last point I'd probably make around just the asset class, being longevity companies in general, is that there will be a baked-in premium to the valuation of the companies because of the socioeconomic impact that the companies will be able to generate. And there also is a foundational baseline here for understanding the inherent value in these companies, because the innovation is real. And drawing a parallel to the biotechnology industry, where a lot of the technological standards draw their inspiration from, we saw that industry turn around vaccines in rapid time and be able to generate real-world impact at scale on a very quick basis. And I'm a fundamental believer that this is just a version of biotechnology 2.0, 3.0, where that innovation is going to have much more meaningful impact for the whole of humanity. I think we've been talking about the I wanted to sort of put up, I'd say, an economic use case or a revenue sort of case study around what a prospective like big selling longevity drug might look like, and how a company might be valued if it has a significant degree of success. We've seen the amount of money that's been raised into longevity companies, but like, what does that mean when a company effectively goes commercial? And how could a prospective longevity drug sell? And I wanted to draw parallels to a newly approved drug that's effectively come out of Eli Lilly called Mounjaro, or tirzepatide, which is basically treating type 2 diabetes and obesity, and is slated to have $100 billion annual sales potential. And the reason why I draw a parallel to this drug, apart from its sort of interrogating and fundamentally working on the metabolic system, is that this drug was developed just assessing fundamental human physiology, the same way that effectively longevity drugs will look at the 9 hallmarks of aging, or another fundamental characteristic of physiology that's related to age-related biology. The drug development efforts there looked at physiology fundamentally, as opposed to the old conventional pharma way of doing things, which was like examining phenotypic condition and then developing a drug that seemed to have curative or sort of symptomatic remediating potential for a type of disease. This drug, as slated by Bank of America, will probably go across a variety of disease indications, and it's in its phase 3 clinical trial. In the weight loss study, it resulted in a 20% weight loss benefit over 40 weeks to a participant cohort of more than 1,000 people. A drug that holds that degree of sort of like weight loss potential is something that I would think would have appeal to a lot of people within the general public. I think you need to have type 2 diabetes to think about the prospect of being able to take that drug. So there is baked into that revenue estimate is the idea that people actually go and seek the drug on an off-label basis to take it to actually manage weight-related issues. And just to put that type of revenue potential into place, that means that a company with one drug that has that type of revenue potential will have a valuation that will be in the tens and tens of billions. I think that the market cap estimate for that one drug alone to Lilly is somewhere between $30 to $40 billion in terms of market cap. So that is the revenue potential and the valuation potential of just one drug that you could prospectively see coming forth within the longevity space. I think I just wanted to also make a case that I think that there's going to be an acceleration of companies purporting to treat age-related disease and also develop longevity drugs. And I think that there's a structural pull in that respect, because we have 13,000 recognized diseases from the World Health Organization and 1,500 approved medications. The return on investment from pharma R&D is effectively been declining on a long-term basis, and I think that part of that is effectively ascribed to the fact that they really are developing drugs just to treat disease, and they're not trying to understand the inherent physiology of human body and what drives disease. And the case that's always been made by the longevity community, that there is a common thread to a lot of diseases, and that fundamentally is age. And so I do think that we may see over the longer term that R&D yields within this area of research specifically will actually increase, which is a good thing for people investing within the area, because it really does increase the probability of success for having market-approved drugs. On the M&A side, just to give you an idea about what a takeout of one near market-approved drug might look like, or a drug that's effectively just starting to commercially launch. You're within biotechnology and more significant disease areas, you're talking about $10+ billion for a company that would effectively be acquired by pharma for just one drug and one drug alone. The last point of my talk here, I just wanted to actually go through diligence factors and risk factors for effectively making an assessment into or evaluating an investment into a company. And it breaks down to a few fundamental concepts, but these are I would say these are a little bit different to the way that you would assess a normal startup. And so the first thing I really wanted to run through was actually scientific risk. There is, much of the science is really novel within the space, and there isn't really a meaningful sort of convergence in scientific opinion about whether the biology that's being sought to be understood is accepted. And so there is a degree of scientific risk that people have to sort of get comfortable with. But one way to effectively get your head around that, and this is probably something I would guess that everyone in the room is doing, is that they're probably deeply engaged within a lot of the industry publications, listening to a lot of the podcasts, and also just getting an understanding as to what the scientific opinion leaders are really saying about some of these areas of research. The next point to really assess when you're looking at investment is just really the person that's sitting opposite you. That is the founder. That fundamentally is their vision. And also just to assess their tenacity, their grit, and whether they have an unwavering nature to stay the course and really be able to see the vision execute over the longer term. And what I would implore people to do here in your efforts in sort of having discussions with companies is to see whether there is execution detail that sits around the way that the company looks at doing things. I mean, ideas are great, but vision without execution equals delusion. And you want to get a real strong sense of understanding about whether the company has a very detailed plan about how they're going to raise further financing rounds, how they're going to recruit people, where the drug is effectively going to be made available, how they're going to run their clinical trials, how they're going to recruit a board. And I think that that's something that needs to be intimately understood when you're effectively making an investment. And obviously that's an investment principle that stands for investing into any industry sector. The next point here is, and it was actually a point that Phil was sort of touching upon earlier, is just really the assessment of clinical risk. Clinical risk really being the stages of research and development whereby you're actually trying to assess overall within humans whether the drug is safe and whether it is effective. And that moves through a number of particular stages, I'd say emanating from sort of an embryonic idea as basic research and, articulating a hypothesis, then to moving into elements of, early discovery where you're starting to get at least some degree of biological validation around the idea through lab work, to then moving to preclinical in vitro models where you're sort of using target cells implicated within that implicated within that biological interrogation to see whether your drug has the desired effect within those target cells. Then moving to effectively in vivo validation, which is taking model organisms, so mice, dogs, etc., and seeing whether there is purported safety and efficacy within those model organisms, so that you can then actually start to look to moving in humans. Tailoring off the back of that is IND, enabling studies. That's basically investigational new drug studies. These studies are effectively required by global regulatory agencies to permit a drug to be put into humans. That really assesses toxicology and pharmacological properties of the drug, and that data would effectively be tabled to regulators. If and when you effectively get that approval, you move into human-based clinical studies, which is fundamentally broken down into 3 parts. So phase 1 is really just assessing the safety of the drug and whether the drug exhibits tolerable characteristics and doesn't have high nature of toxicity within humans. The phase 2 clinical trials is probably, I'd say from an investor perspective, the most meaningful time to assess the virtues and the merits of the company, because this is where you're going to reach a human-based clinical proof of concept. So at a small clinical scale, does the drug work and exhibit the purported benefit within humans? So you would have established the safety, but you'll start to see the efficacy signals coming through here at a phase 2 study. If that's all good, this is where you gear up for your late stage phase 3 registrational studies, which are sort of large scale studies where you're trying to take a representative cross-section of society and apply the drug to a broader cross-section of society and see whether that efficacy that you saw at a small scale actually applies to a broader group of people. These studies tend to be relatively expensive. I would expect that most companies that you're looking at from an early stage will end up having a pharma partner or someone else at this point in time to help them run those studies, because those pharma partners will also probably be mindful of what commercialization of the drug might look like, how it's effectively going to be marketed, how it's going to be made available, and then also thinking through payer-related discussions. So how will the health insurance market really think about the pharmacoeconomic benefit of the drug being delivered out to patients? Another point, so just speak about regulatory risk, it's probably another point pertinent here to just assessing longevity companies, because most longevity companies are they're developing dual purpose drugs that treat diseases that are currently recognized by authorities, but the drugs are developed with the ultimate goal that they could prospectively be given to humans on a prophylactic basis to stave off disease or just to help slow down the aging process. Unfortunately, regulators aren't quite there yet at the moment, but there still is tremendous commercial potential in being able to treat disease. And so I think thinking through the degree of regulatory risk that might be associated with what companies are seeking to do, and just particularly whether these are new clinical indications that they're effectively seeking, and just like the way that expansion indications might effectively work. The commercial risk is another point to effectively assess. So this is just, will the drug sell? Will it be appropriately marketed? Is the delivery mechanism appropriate for its mode of administration and the frequency in which the drug actually needs to be given to people? And just 2 more points here, just in relation to risk factors or just general points of diligence to be assessed. Financing risk. This is something that is, I think, rather quite significant, maybe a little bit esoteric to the area, albeit that I think like most startup models run a significant degree of finance risk these days, which is that drug development is expensive. It's going to require follow-on investment from investors, and what you need to assess, what you need to get an understanding of is what will be the ensuing capital formation conditions for a company to continue as a going concern and be able to fund their clinical trial aspirations and their growth goals and objectives moving forward into the future. Last point really here is just please make sure that the intellectual property is effectively assessed also. So whether it's a provisional patent that's being filed or they have patents granted that are either outline that the drug might be a new molecular entity and therefore protectable as something novel in itself, or that there's prospectively a method of use patent that would sit around that. But that ensures you 20 years of statutory protection for the monopolistic exploitation of the commercial potential of that drug. But that's not without the intellectual property. It's a lot of these things will tend to actually be meaningless. Just one last point that I wanted to conclude on, which was really an ask from everyone in this crowd. I think in trying to advance such a big topic as longevity, it needs a lot of stakeholder participation, and it really needs evangelism from its core shareholders. I think we're fortunate to be sitting within an industry sector that's attracting a lot of investment and has a lot of interest sitting behind it. But as we know, with the progression of any type of technological revolution, it's never ever smooth. And I think what's helpful for founders and people that are sort of really deeply entrenched in the ecosystem is to ensure that there is that there's some degree of evangelism from all the people that sort of are situated around them. And so, I think that investors, you're doing yourself a favor by talking your own book and really actually trying to promote the value that sort of sits within your company. And I think I think it would do the world of good for a lot of the founders and a lot of the people within the ecosystem to make sure that you're speaking the virtues of the investments that you effectively make. And with that, my talk is concluded. But sorry, that was an off-the-cuff talk about investing into longevity.